Welcome to the glorious world of Chapter 8, where we'll learn all about long-term assets. So the first thing we're going to do is define what is a long-term asset. And a long-term asset is any asset that's going to last for more than 1 year. And they can really come in two different types, tangible and intangible. Tangible are those with physical substance, like the land that you see when you look out your window, the building that maybe you're in watching this delightful video, the fixtures and equipment that the business may use, and natural resources like oil, timber, coal, and others. Intangible, long-lived assets would be like patents, copyrights, franchises, licenses, and trademarks. They really represent a right of something. For example, a patent is the right to be the only one that can produce a certain product. A copyright protects works such as TV shows or books. So they're intangible in nature, but they still provide value to the business. So we'll take a look at Southwest Airlines' balance sheet, and you can see that they have a large amount of property and equipment. The vast majority of their equipment is the flight equipment, which would be the planes, and then they have ground and property equipment. They have a lot of deposits on flight equipment purchase contracts, and then assets constructed for others. So we're not going to focus on things like the deposits on flight equipment purchase contracts, but that would be deposits that they made on large planes. So that's a future asset because those deposits are going to turn into planes eventually, but it takes a long time to produce planes. We're going to focus on more typical stuff that we're used to seeing, like computers and land and buildings, and determine how we record the value of the asset as well as the related depreciation and amortization. Remember that depreciation is a systematic allocation of the asset's cost over its useful life. So because the matching principle says we record the cost of assets when used, these long-term assets aren't used up all in 1 year, so we allocate that cost over the useful life of the asset. So let's talk first about how we record the purchase of these long-term assets. So the acquisition cost includes the purchase price and all expenditures needed to prepare the asset and get it ready for its intended use. So the question you want to ask yourself is, did I incur the cost to get the asset ready to use? If yes, include it in the cost of the asset. If no, exclude it. So I'm going to go over some examples with you that are tricky sometimes for students. So rather than memorize some comprehensive list, just ask yourself this question and see if you can come to the right answer. So obviously the purchase price of the asset would be included. Let's visualize being back in Paul and look up at the ceiling, and you'd see a projector that would project this PowerPoint onto the screen. So the cost of the projector obviously would be included. What about the shipping costs? Yes, that would be included too, because I can't use the projector unless I have it. So the shipping cost to get the projector would be included in the cost of the asset. What about the installation costs? Again, the answer is yes, because I can't use the asset without it being installed. What about sales tax? A lot of times when I ask that in class, students say no because they were born and bred in New Hampshire where live free or die and no sales tax here. Well, that's not entirely true. We do have meals and entertainment tax, but either way, if we pay sales tax to get the asset, that's a required cost to get the asset ready to use. So sales tax would be included in that one when it shows up on exams. Students, I don't know if it's a New Hampshire thing, tend to mess up on. What about training? Do I need training costs to get the asset ready to use? A lot of students would say yes to that, but you'd be incorrect. Training is not required to get the asset ready to use. It's ready whether I have training or not. What about insurance? No, insurance is not required to get the asset ready to use. Is insurance a good idea? Sure, but it's not required. What if we were talking about a car and we were in Massachusetts where insurance is actually required? Would the insurance cost then be included in the asset? Some of you probably think yes, but you're wrong. It's no. Is the car ready to use without insurance? Yes, it is. Is insurance required to legally drive the car? Yes, it is. But do you break the law sometimes? Yes, you do. Have you ever driven above the speed limit? Yep. So you break the law. The car is ready to use without insurance. So insurance is not included. So to summarize, the purchase price is a common item that gets included. Shipping cost included. Installation included. Sales tax included. Insurance, good idea? Yup. Required to get the asset ready to use? No, so it's excluded. Training, good idea? Sure. Required to get the asset ready to use? No, so it's excluded. Those are the ones that students tend to mess up on. So here's some examples of things that would be included in acquisition cost. You'll see a lot of the items that we went over are in this list. But again, I really think if you ask yourself, did I incur the cost to get it ready to use? Yep. Include it. No. Exclude it. You'll be good to go. When we say expenditures are capitalized, that means we're recording them as part of the asset cost. So let's go through some examples. Southwest Airlines paid cash for an aircraft and transportation and preparation costs. So how would that be recorded? Well, the amount that they pay would get recorded as equipment and then cash would go out. So in our accounting equation, A equals L plus E, revenue minus expense equals net income. If we paid $120 cash for transportation and for the equipment and any transportation and prep costs, our equipment goes up $120 and cash goes down $120. Remember, we don't think in terms of debits and credits, we think in terms of up and down, and then we convert it using our conversion guide. So equipment would go up with debits and assets go down, cash with a credit. If we made the purchase for a note payable, the only difference is under our accounting equation, A equals L plus E, revenue minus expense equals net income. We'd have the equipment going up, the $120, but then we'd have a note payable liability going up $120 if we weren't paying for it with cash. Here, it would have been helpful if they told us the numbers. So they're saying they paid $2 million in cash, and then the remainder is on a note payable. So given that new information, which obviously we'd have to provide you in the problem, the equipment's still going up $120, cash is going to go down $2, and then the note payable goes up the difference of $118. So to make the equipment go up, we debit it. To make cash go down, you credit it. And to make a note payable liability go up, you credit it. Debits equal credits, and A equals L plus E. Frankly, this is stuff we could have done in Chapter 2 when we were learning about transactions that affect the balance sheet. What if we buy equipment with stock? So Southwest gave Boeing 1 million shares of $1 par value stock with a market value of $55 a share and paid the balance of the plane plus transportation and prep costs. So if the equipment costs $120 million, we're going to record the asset, write it out here for us on the accounting equation. We're going to record the equipment for $120. The market value of the shares is $55, so we're going to have under our equity, we've got common stock and additional paid-in capital. We also have retained earnings hanging out, but it's not going to be affected by this transaction. Remember from Chapter 2, the number of shares times par goes into the common stock. So 1 million times $1 would be 1 million. And then the market value is 55, so the excess goes to additional paid-in capital, which would be 54. And then the remainder that we owe, which is 65, would come out of our cash. So we paid 65 of the 120 in cash, leaving us with 55 million, which we covered with stock. When we issue stock, the number of shares times par goes into the common stock account, and the difference goes into additional paid-in capital. It balances out because the net impact under assets is a positive 55, and that's also the impact under our equity. Asset costs, when we are building an asset, includes all materials and labor traceable to construction. It includes a reasonable amount for overhead costs, which are the costs associated with various things that go into building a building, which would be like the utilities and other costs associated with the architect and their office and the little trailers that you see outside getting set up outside of a construction site to run the construction site. Those would all be examples of overhead costs. They don't directly go into the building, but they would be examples of additional cost incurred in order to make that building. And then we also include interest on the debt incurred during construction. It's important to know that the only time interest is included in long-term assets is the interest that we incur on our liabilities during the construction phase. Once construction is completed, the remaining interest on the loan would be recorded as an expense and would not be included in the cost of our asset. So if a Southwest constructed a new hangar that costs $8 million in total, which is comprised of $2 million in labor, $5 million in supplies and materials, and $1 million in interest expense, how would they record that journal entry? Well, they would record the building for $8 million and the cash going out for $8 million, just like they'd record the purchase of a building for $8 million. In our assets equal liabilities plus equity, building goes up 8, cash goes down 8, so the net effect is 0 and the accounting equation would balance. When we have long-term assets, there are times where we have to make improvements to those assets or maintain them. So if you think of your car, an oil change is necessary to keep the car running. It's not going to extend the life of the asset because when you get the car, they give you the maintenance schedule and it tells you need to do oil changes in order to keep the car working as intended. So those ordinary repair costs are going to be treated as an expense and recorded as an expense in the period in which they are incurred. If we make a major improvement, like we put a new engine into a car, that's going to extend the normal useful life of the car. So that type of cost would be a capital expenditure and it would be included in the cost of the asset. The reason this matters is because if it's something involved to keep the asset running normally, it's expensed right away in the period in which it's incurred. If it's a major addition to a building or like adding a new engine to a car, it adds value to that asset and we record it first as an asset, which then will be depreciated over the remaining useful life of the asset. So it affects net income because if we expense it right away, it impacts net income right away, whereas if we capitalize it, it is going to be added to our assets and won't affect net income until we expense it through depreciation in the future. This slide provides a nice summary of the difference. So when we capitalize it, we include the cost on the balance sheet account. The expense is deferred until later when we expense it through depreciation, which means currently our income and our taxes are both going to be higher. When we expense it as a repair, the income statement expense account is debited, which means expenses go up, which means in turn that our income and our taxes would be lower. To avoid spending too much time classifying additions and improvements and repair expenses. Some companies record all expenditures below a certain dollar amount as expenses. So a lot of companies use $1,000 as a threshold. Anything less than $1,000 they just expense. If it's more than that, then they'll track it and depreciate it over time. These policies are acceptable even if the addition provides future benefits, because remember the concept of materiality. If an amount is small enough that nobody cares about it, we don't need to follow GAAP rules. Let's go through an example. Southwest paid $1 billion in aircraft maintenance and repairs. How do we record this? Well, we're going to record it as an expense. So under our accounting equation, expenses would go up 1,000. These numbers are in millions, so 1,000 million is $1 billion. It's the problem when you try to use real-world examples, the numbers are obscenely high. That makes net income go down, and in turn our equity go down, and then our asset cash would also go down. To record that in debit and credit format, we debit the expense and credit the asset. If we spend $300 million to modify the interior of an aircraft to reduce fuel consumption, then that is going to be treated as a capital expenditure. So our asset's going to go up by the $300 million and our cash would go down. So the difference, as you'll see in a minute, is that when we have an expense, it affects net income, whereas the capital expenditure does not. So we'll have equipment going up the 300 and cash going down the 300 as a result of this capital expenditure. And you can see net income, or in the entire income statement for that matter, isn't impacted at all at this point. So that's the main fundamental difference, is that when we record expenses, those impact net income right away, whereas if it's a capital expenditure that provides a future benefit, net income isn't impacted. Instead, assets go up as a result of the expenditure. That is, the flight equipment goes up. The net effect to assets is zero, because if we're paying for it with cash, the equipment goes up, cash goes down, so the net effect is zero. But instead of recording an expense, we're recording equipment. Why should you give a shit about this? Why does it matter so much? Well, because companies can manipulate their income by recording things that should be expenses as assets, or vice versa. And that's exactly what happened in WorldCom, which is now part of Verizon. They inflated their income by recording a bunch of expenses as capital assets inappropriately. So that resulted in the company overstating their income by billions of dollars. And in 2004, the auditors discovered $74.4 billion in necessary restatements were required from them having recorded expenses as capitalized assets. So obviously recording these in the appropriate classification is important, because it can have a big impact on net income, which in turn affects the shareholders and investors' perceptions of the company.